There you go.
There's your answer. Okay, good evening, everyone. I'm just going to give it a minute for a few more people that are joining. Uh, whilst everybody's waiting, good evening. Welcome to tonight's webinar with myself and Bill Henderson. Some of you know, most of you may know, the senior transition consultant and broker at Tier 3, part of Henry Schein. Before we kind of jump in, I do have a quick poll that I wanted to just some questions while we're getting started. If I could just move my screen. Yeah, so you should see some poll questions. If you just take a minute while everyone's joining, just answer a couple of questions about what your actual plans are in terms of your lease, if you're looking to start practice transition, would like some more information from tier three. Appreciate everyone. Just take a minute to just fill that in. And then I will pass over to Bill, who's going to start tonight's presentation.
I'm disappointed. It says hosts and panelists cannot vote.
Yes, we're not allowed. Okay, so it looks like we've got a few more attendees that have just joined, which is great. Um, so let's get things going. In terms of just some housekeeping, there is a CE, one CE continuing education voucher that you'll get normally via email within probably 5 to 10 business days. And then yeah, if we Bill will go first, and then I will speak after, and then we'll at the end we'll save some time for some questions. So I'm going to pass over to you, Bill.
Okay. Well, thank you very much, Lee. I'm looking forward to this. Just give me a second to get screen sharing here. And you can tell me if I'm successfully screen sharing.
You are good to
And can
go.
you see my cursor moving on the screen?
Yeah, you can a little bit.
Okay, good. Okay, everybody. What I wanted to talk about today is what's likely coming at us in 2026. But if we're going to talk about navigating value in 2026, we need to begin by understanding how practices get valued. And one of the biggest changes from 18 years ago when I bought Tier 3 until today, I no longer own it. I sold it to the lovely people at Henry Schein. I'm working because I'm having fun, not because I have to anymore. But one of the biggest changes is broad, much better understanding that the value of your practice is driven by earnings and not by some theoretical combination of your hard assets, the value of the chair and op two, and the leasehold improvements and the equipment and goodwill. My only issue here right now is, oh, there we go. I'm advancing slides now. Sorry. So I'm going to cover three things. What determines value? Where are practice values today at? And then what are the key risks and opportunities in 2026? And I'm going to talk a bit about what may happen after that as well. It's an understatement to say that we're dealing with significant uncertainty right now economically. There's certainly a very real risk of a recession. Interest rates are going to play a role going forward. I'm going to talk a bit and passionately about CDCP because there's some real pros and there are some real cons. And then I'll wrap up with some quick value building strategies. The last of which is having a great lease, which will be the perfect handover to Lee. The If you want to do a ballpark valuation of your practice, it's actually a lot more complicated than this, but you can all play around with this if you want. You begin with your financial statement. But the key thing to understand about the financial statement that your accountant prepares for you is it's a tax document, or a tax reduction document more appropriately. Your accountant wants to make it look like you're earning as little money as possible to save you taxes. It is not an accurate representation of your business for a new owner. And you can see that right here. This is an example of a $2 million practice. Pretty standard cost structure, staff costs coming in at 29%. The associate in the practice making 230. The owner, based upon what his accountant advised, is paying himself and his spouse in total $280,000. But that's a tax calculation, not a real business operating cost. The accountant has put in $5,000 worth of auto expense, $5,000 of meals and entertainment. I'm sure the $10,000 trip to Vegas for a conference truly was critical to the operation of the business. That's why the accountants put it here. But a new owner is not going to have that. So the key step in determining what your earnings or your EBITDA are is to basically look at your practice and treat yourself as if you were an associate in your own practice. That means removing all of the stuff your accountant put in there, including what you're being paid, paying yourself as if you were an associate, 40% on the dentistry you're doing, removing personal expenses, removing expenses that you wouldn't pay for your associate, and then removing amortization, because this thing called EBITDA is earnings before interest, taxes, depreciation, and amortization. So you have to remove amortization. So if we start with that $2 million practice that the accountant said was making $420,000, here are the normal adjustments one would make. The owner was paying themselves and their spouse $280,000. The spouse isn't actually working in the practice. And if we pay the owner 40% on their production, they'd be making $250,000. Rent doesn't change, of course, unless you're expensing a home office, then you'd pull that out. Supplies, I'm sure it was just a bookkeeping mistake, but somehow $10,000 of purchases at Costco and Home Depot ended up being charged to the business that were really personal expenses. So those get added back. Supplies come down from $150 to $140. Auto. I am sure that all of you that are expensing an auto in your practice are carefully tracking the miles you drive doing house calls and going to and from the lab. But if you're not making house calls and going to and from the lab, then this gets added back or gets zeroed out. Same thing for meals and entertainment. Dues and fees is interesting because there's, your provincial association fees are absolutely a real cost. But it's a cost of being a dentist, not operating a practice. If you've got an associate working for you and you're in BC, I guarantee you're not paying the associate's BCDA fees. So dues and fees get added back because they're a cost of being a dentist, not operating a practice. The Vegas trip that was very educational gets zeroed out. And telephone, in this case, the owner of the practice is writing off $5,000 of their cell phone, which I know they're only using to call patients, but the real office phone expense is $5,000. Then I mentioned EBITDA is before amortization, so we add back the $30,000 in amortization. So the expenses in this practice went from $1,579,000 down to $1,480,000, and the earnings have gone from $420,000 up to $520,000 simply by looking at the practice as if the owner was an associate in it. And this is the EBITDA or the earnings that gets used to drive value. How does it get used to drive value? Well, it's a little overly simplistic for me to say it, but you will hear people talk about earnings multiples. And if this practice is making $520,000 and a buyer is prepared to pay 6 times earnings for it, which is a good normal earnings multiple, this practice is worth $3,120,000. Some of you will have seen old appraisals, and there's one nationwide appraiser still doing it, which delights me to no end because it gives us a huge competitive advantage. But you've probably seen appraisals where they took the value of all the equipment, the chair in op 2, the light in op 3, added to that value for the leasehold improvements, and then added a fictitious number on goodwill. The reason that doesn't make sense, and frankly, it's why I bought a brokerage when an appraiser presented my wife, the dentist, with an appraisal like that. The buyer cannot repay their bank loan with the light in op 3. Nor can the buyer pay for groceries next week at their grocery store with goodwill. Buyers can only fund their lifestyle and repay their bank loan with earnings coming out of the practice. And given how the demand for practices today, the value of your practice is driven by what a banker will loan a buyer, and that's driven by the earnings. So if you take nothing else from what I'm going to say today, if you build your earnings, you're building value in your practice, and frankly, your personal net worth. If you lose earnings, you are losing value. And I have a conversation every 2 or 3 weeks, it seems, with the dentist says, "Oh, Bill, I need my practice appraised, but look, I've been slowing down. I used to do much better. So I'm sure you can adjust my earnings upwards to where they used to be." I can't do that. No bank will loan against that, and no buyer's going to believe it. So the sad reality is, when you're selling your practice, you're pretty much only as good as your last 12 months. And there are exceptions to that, but especially those of you coming into your final years, you need to be paying attention to earnings. So I said that, you've got the cash flow times an earnings multiple. You saw here that range in multiples is 4 to 8.5, 8.75. This sort of shows you how that range breaks down. I didn't get notes on where everyone on the webinar is from. This varies a bit province to province. It definitely varies based upon where you are. If you have a really good practice and you're in a high demand area, by high demand, most major urban centers. So, the GTA, Ottawa, Calgary, Edmonton, Winnipeg, Lower Mainland, BC, Regina, I'm missing some of them. But generally, you're going to be looking, if you're selling to a private buyer, at between 6 and 6.5 times earnings. Why 6 to 6.5? Because above 6 and 6.5, there aren't enough earnings to repay the purchase price. I'll talk about DSOs in a second. But if you've got a challenge practice, this has been the biggest change in the last, I would say, year. Used to be we could sell anything. Practices with significant challenges have become much harder to sell in the last year and are selling at lower multiples, 5 to 6 in a high demand area. And you've probably read down and seen 4 to 5 in a low demand area. What do I mean by challenges? If you've got insufficient time left on your lease, if you've got a demo or a relocation clause, Lee, I'm sure we'll talk about these at length. If you've had year over year of revenue decline in the practice, frankly, if the practice is just really old and out of date, that's going to penalize you more now than it used to. But if you've got a good practice, major urban area, selling to a private buyer, you're 6 to 6.5. In a lower demand area, I don't want to pick on Estevan, Saskatchewan, if there's anyone on the call from Estevan, but that's not as high a demand area. So, that'd be down in the 5 to 6 range. That would broadly be true in Atlantic Canada and very rural areas of big provinces like Ontario. If there are any specialists on the call, the bad news is your multiple is going to be lower. Generally, specialty practices are going for 4 to 5 times multiples. The good news is you're probably having higher earnings to begin with. So you've got a higher earnings number multiplied by a smaller multiple, you're still going to do just fine. You will see on here, though, that I've got DSOs. I'm sure everyone knows that's dental support organizations such as Dental Corp, 123 Dentists. There are now, in most regions of the country, at least 10 to 15 of them. And they will pay higher multiples, but they're doing that because you're going to reduce their risk for them. The general deal with one of the well-established DSOs is you're going to sign on for 3 to 5 years. You will guarantee the top 10% of earnings for that time period. And so you've substantially reduced the risk to them, and therefore you're going to get a higher multiple. And these are general ranges I'm showing you here. A proper appraiser doing proper work is going to look at basically the factors you see here. Supply and demand drives multiples. That's why high demand areas have higher multiples than low demand areas. Risk and opportunity is key. And the next point there is your earnings may not be a buyer's earnings. You all know that your personal approach to diagnosis, treatment planning, your ability to get case acceptance, the work you do yourself versus what you refer out is going to be different than a new owner's. And if you're a very conservative dentist referring a lot of work out, there is inherently earnings opportunity in the practice. And that will translate into a higher earnings multiple times current earnings, because an appraiser doing their job right is going to be forecasting those increased earnings. In that regard, patient count is key. The reason I bought a brokerage and built it coast to coast is because the broker that did my wife's appraisal said right on the appraisal, we do not counter audit patient charts. The most important thing the buyer is buying is patients. So thank you to that company because they've given me a wonderful life. In your practice, working with somebody who's going to really understand your patient counts is key. Okay, so that's basically what determines value and where values are at. If you're hearing people talking about values relative to revenue, they don't know what they're talking about. Because earnings vary so much relative to revenue. So what I want to do now is take a few minutes and walk through what's coming at us in 2026. But before doing that, I will use this caveat. This is one of Yogi Berra had a lot of great sayings. This is one of my favorites. It's tough to make predictions, especially about the future. So I don't pretend to have a license on exactly what's going to happen. There's some things I'm pretty confident in, and some things I'm not quite as confident in. The big picture, and this applies whether you're going to buy a practice in 2026 or sell a practice or just continue operating your practice, is you've got a lot of things going for you. You are in a recession-proof business. I'll show you that in a minute. Across the provinces, you've got suggested fee guides that recover cost increases for you or more. You're in a world of declining interest rates, which increases practice values or makes it easier to afford a practice. And at least in the short term, you've got the government dumping $5 billion a year into the industry. I'll talk more about why I said in the short term in a minute. But you've got a lot going for you. I said dentistry is recession-proof. This is a chart I pulled together looking at literally the last 45 years of year-over-year growth in Canadian dental expenditures. You probably may not be able to see all the numbers on here, but if the bar is above this line, it was year-over-year growth. You can see that over the last 25 years, only twice has year-over-year revenue declined. One, of course, was COVID when your offices were closed for 2 or 3 months, but you can see it more than bounced back the next year. And the other time was in 2010 when revenues dropped 2%. These sort of yellow boxes are recessions or major economic slowdowns over the last 45 years. There were 7 of them. And only once was there any drop in year-over-year dental revenues, and that was a very modest 2% drop. So you truly are in a recession-proof business. And that's something to keep in mind. If you're a buyer looking at buying, my goodness, get in now. Don't wait until the folks who are nervous suddenly develop more confidence. Interest rates. You probably all realize interest rates impact what you're going to get paid for a practice or what you can pay for a practice, because interest rates are a critical component of what the bank's going to want you to pay back. And this shows interest rates over the last 10 years. If we looked at this on a 20-25-year time horizon, everything on this chart looks low. But we've been chugging along in sort of the 3 to 4 range, dropped during COVID down to the low 2s, spiked all the way up to 7%. And that definitely exerted a chill on practice values and sales. But we've come down nicely since then. We're sitting at 4.45 now for the prime rate. And if you're looking to buy a practice, you will get your money at prime minus a quarter. So you'd be borrowing your money at 4.2%. Very few other professions get terms like that. Virtually none. Vets do, medical doctors do. You'll get 100% of the purchase price of the practice, so long as it's been appraised properly and the cash flow works, at prime minus a quarter, amortized over 12 years. If you're buying a building with it, the building will be prime minus a quarter, amortized over 25 years. And that's better than virtually any other businesses get. And you all know that banks are not charitable institutions. So what you can take from that is the simple fact that dentists don't go bankrupt, because otherwise banks wouldn't loan you money on these terms. Total number of bankruptcies amongst dentists in 2024, I haven't run the numbers for 5 yet, according to the superintendent of bankruptcies, was 7 across the country. So interest rates are helping practice values now. And there is a reasonable probability we could see lower rates in the future if all of the Trump craziness continues to eat away at our economy. The central bank is monitoring closely. They walk a fine line between not wanting to provoke inflation, but wanting to keep the economy going. That's why we've seen 2 rate reductions in the last 3 months. And please don't tell anybody I said this, because it's going to sound horrible, but what you should all be hoping for if you own a practice is a recession, because not only are you recession proof, interest rates will drop to counteract the impact of the recession. That will drive practice values up, not down. I don't truly hope we end up in a recession, but it just illustrates how good most dentists have it today. Now, let's talk about the CDCP. Where do things stand right now? Well, we appraise over 300 practices a year. What we're seeing is pretty consistent. Patient counts are up. There are definitely ongoing operational issues, and I don't want to belittle those, but billings are up too. We're seeing increased hours for staff, because if you've got more patients, you need more staff. The demand for staff is definitely eclipsing supply. That is driving wage inflation for hygienists and chairside assistants that I know is challenging for many of you. But so far to date, the suggested fee guides in most provinces have more than covered those increases. We're seeing there are only two provinces, Ontario and one other one, I forget which one, where you can combine CDCP benefits with the provincial welfare programs. In Ontario, that's ODSP and Healthy Smiles. And if your province doesn't allow you to do that, you should be following up with your provincial dental association, because the ODA succeeded and whatever province I'm forgetting did as well, but most didn't. Overall, it's been a positive impact so far. And if you look at the graph in front of you, there are more gains to come. It was estimated at the start of CDCP that roughly 9 million Canadians were going to qualify for CDCP. As of right now, there are 40% that haven't even enrolled yet. Of those that have enrolled, about a third have enrolled and used the program, and a third have not. So when you look at that, there is the potential for whatever benefit you've seen from CDCP to at least double, and I doubt it will ever triple, but you're going to see a lot more from CDCP going forward than you have in the last year and a half. After all, the people in the 18 to 65 cadre just qualified 6 months or 5 months ago. So CDCP so far has been pretty positive. I am very concerned, though, that dentist attitudes have swung too far. 18 months ago, I couldn't raise the topic of CDCP in a session like this without people crapping all over me. Dentists were appropriately at the time uncertain, angry, and afraid. Today, most dentists I talk to are relatively satisfied and unconcerned. The ODA has done polling on that regard, and over 65 dentists in Ontario are relatively happy with where things are at. And I think you're being too complacent if that's where you're at, because I continue to believe that this remains the biggest risk to dental industry economics that we've seen ever, I think, certainly in the last 50 years. And I want to explain that because it's very concerning for the future. What are the risks? There are three. The first risk is revenue compression. I'm sure everyone on this webinar is sufficiently financially literate to realize that our government is running a massive deficit, and it just got a lot bigger. If you think the government will have the money to keep the CDCP fees moving upwards in line with inflation, you're a far more optimistic person than I am, and I'm a pretty optimistic guy. So there's a very real risk going forward, simply that the government can't afford the program and therefore does not increase year-over-year reimbursement levels. I think the bigger one is deinsurance, which is, I can tell you, if I were running a business today and most of my employees were making less than $90,000, now that the government is providing dental care to people who don't have an insurance plan and are making less than $90,000, why would I be providing it to them? And there's no good measurement of how much of this is going on, but anecdotally, it's starting to happen, and it's only going to gain momentum. So we've got an issue where the reimbursement for the government is unlikely to keep up with your cost increases, and more people may qualify for the program as employers stop providing dental care insurance. And then the third risk is your association, no matter what province you're in, and the CDA fought very hard to give you the right to balance bill. And by balance bill, I mean taking whatever the CDCP reimbursement level is and billing up to your normal fee guide. They fought hard. The government did not want that. The government wanted you to be doing dentistry at a maximum of the CDCP reimbursement level. The associations persuaded the government largely because many of you took so long to sign up that dentists wouldn't sign up unless they could balance bills. So you've got that right. But like many rights, if you don't use it, you're going to lose it, or you may lose it. And my number one concern is there are far too many dentists not balance billing. And it is very much short-term gain for long-term pain. Sure, if you tell people we accept CDCP and you won't have to pay anything more than your CDCP copayment, and if you've got 100% reimbursement, you won't pay an extra cent before leaving my office. Sure, you can attract more patients. But ask yourself these 5 questions. Are you comfortable letting the government dictate your prices forever? Do you think government fees will keep up with inflation? For those of you in Ontario, and I apologize, I'm not sufficiently knowledgeable about each other province's plan. I know this is true for many of them. When ODSP and Healthy Smiles started in Ontario, they were at 85% of the fee guide, right where CDCP is today. Today, they're at 30%. So if you think the government will keep the fees up, you haven't learned from what's happened in those programs. And are you okay with providing an incentive for deinsurance? If you've got a patient whose family member qualifies for 100% reimbursement and you're not charging the balance billing up to the fee guide, their sister or brother has a big incentive to go to the employer and say, hey, look, I'm paying an 80% copay on the plan you're giving me. Oh, why don't you cancel the plan so I can get the same deal my brother or sister's getting? So I think people who aren't balance billing are provoking increased risk of deinsurance. And then the last one, is it really a good idea to show politicians that dentists can get by at the CDCP reimbursement rate? If the logic hasn't been good enough for you, let me show you the numbers. In general, CDCP reimbursement rates are running, varies a bit province to province. Ontario's at 86. I think BC's slightly below 85. Anyways, it varies province, but generally 15%. So here's a practice that is balance billing up to the fee guide. Here's one that isn't. 15 on every $100 in revenue, 15% less revenue. Now, I don't know about you, but I don't think your staff is going to take a 15% wage cut. I know your landlord won't reduce your wage or your rent 15%. I sold my business to Henry Schein, and I know them well enough to know they're not going to cut your supply costs 15%. So that 15% flows straight down to the bottom line, but given all your fixed costs, the $15 you've given up for every 100 comes right out of your earnings, and you're looking at 30% drop in earnings. If you have an associate you're paying, it gets even worse. There's the 15% drop in revenue. Now, the associate's making 15% less, so it's going to be harder to attract associates if you're not balance billing and they've got a choice to work someplace where they can, because they're going to make less working with you. Staff, rent, supplies, all other costs don't change. And look what's happened here. Your earnings have gone from $22, because you're paying a bunch of the earnings to the associate, down to 11. That's a 50% reduction. If government funding for the CDCP does not keep up with inflation, and if they let the reimbursement level drop, and if we had 2.5% a year inflation, after just 4 years, they're only paying 75 cents on the dollar, or $75 on 100. So if you're a solo practitioner, you just lost 50% on that patient base. And if you're paying your associate, you go from $22 down to $4, wiping out most of the money you're making. So, when all is said and done, practices that are balance billing up to the fee guide, their economics will stay strong. They can withstand the fact the government doesn't increase CDCP rates because they're just passing on a small increase each year to the patients. Wages can remain strong. They're insulated from declining reimbursement rates, insulated from de-insurance risks because you're balance billing. If somebody moves from the plan they're on with Manulife today through their employer to the CDCP, you're still balance billing up to the fee guide. You'll have more money to invest in training, technology, and equipment, and purchasers are going to like your practice. Number one question I get from buyers right now when we're showing a new practice is, are they balance billing, Bill? Because the buyers have figured this out. If you're not balance billing, you are providing a major incentive to everyone around you to stop. I've had a career that's much longer than I would like to admit, 15 years at Procter & Gamble. I was probably in 10 price wars during that time period where Lever or Colgate, Palmolive would drop prices. We'd respond. Nobody wins in a price war, and that's what you've started if you're not balance billing. The rest of this is pretty self-evident. You're going to have a harder time paying staff. You're going to have a harder time attracting associates. Government controls your revenue now and into the future. You're more exposed to the de-insurance risks, less money to pay for training, technology, therefore quality of care may decline, and purchasers are going to be very reticent to buy your practice. So if I haven't persuaded you, if you're not balance billing, to think about how you can start, then I haven't been as successful as I wanted to be. Those of you who are balance billing, good on you. I know a bunch of people who aren't balance billing because they just want to provide a break to people who need it. But the break you're providing to people who need it today is only going to get deeper and deeper in your pockets. I will tell you, I'm not entirely optimistic, that we're going to avoid this move to not balance bill, which means all of you are going to come under more pressure in your practice if things play out that way. So now more than ever, it is really important to get on top of your practice economics. And if you're within 10 years of selling, it's really important to have a good sense of what your game plan is. Number one point here, every year I get somebody approaching me who says, Bill, I attended your webinar. I heard Lee talk. Everyone was talking about the importance of the lease. I just signed a great new lease for 10 years. Don't worry, there's no demo clause in it. And I got 2 5-year renewals. I'm all set. And I look at their practice and realize nobody's going to buy the practice. They should have sold their patient base. And they've just locked themselves in for 10 years. That happens to me a couple of times a year, I think. So figure out if you're going to be selling your patient base or your practice. How can you determine that? Well, an appraisal will tell you. But as a rough rule of thumb, if you've got less than 1,000 patients coming annually and your patient base is declining, you're getting to the point where the patients may be more valuable than the practice. If you get a proper appraisal done, and not all appraisers do this, some just give you a number, but they will go through and they will do detailed work around your patient count, what attrition you've got, how patient counts have changed year over year, new patient flow, attrition, critical information to have. The number one way to build value in your practice is to build your hygiene program. But do you really know how your hygiene program compares to other practices? The insourcing revenue can give you ways of building earnings. It's bringing clear aligners in-house. I apologize if there are any orthodontists on the call. And looking at other specialty practices you can bring in-house. And moving to in-house lab. If you've got a lab bill that's over $100,000 a year, look at in-house crown making. And focus on staff costs and productivity. If you have done staff contracts in the last 10 years, there's a 50% chance they're no longer valid because there have been some significant changes in employment law over the last 5 years. Waxdale was one, and then there's another one that's just come forward. And that can increase your post-sale liability. This next one is the saddest one I see every year, which is somebody's accountant wasn't a good dental accountant, hadn't been planning with them, or didn't know when the person was going to sell. And they've lost the ability to leverage their capital gains exemption. Your capital gains exemption is 1.2 million per year. You can ladder it up across family members if they bought into the, or if they became shareholders early. You can still do it going forward if the practice value grows. That's worth over $300,000 in after-tax gains. But you may be 2 years away from being able to do that if you've got too much cash in your corp. And the last one, and the handoff to Lee, is that the number one problem we have selling practices is leases that don't support the sale. So with that said, why don't I hand it off to you, Lee, and then you can go through your piece and we can field any questions once you're done.
Okay, great. Thank you, Bill. Just going to share my screen now. Okay, I hope everybody can see my screen and hear me. Thank you, Bill, again. So, yeah, Cirrus Consulting Group. I know some of you know who we are and work with us. But to those of you who don't, just a high-level background about who we are and how we represent the dental community and how we have done for over 30 years. I mean, essentially, we're a tenant specialized representation company founded by doctors, for doctors, really, for the reason that landlords were taking advantage of their healthcare and dental tenant. And since inception, we've negotiated probably over 13,000 dental specific leases. We have over 20,000 leases on file. So we have a really good understanding of you know, this is all we do. And what makes us unique is that we do everything in-house. We have a team of lease negotiators, some attorneys, some with a background in healthcare, some former real estate brokers, some that we've actually retained from the landlord side as well. So we handle all the financial and all the legal negotiations. We also do pay, you know, a substantial amount a month for some proprietary data where we have access to a company called CoStar, where we're able to, you know, get some information, rental rates, vacancies, and to dig into practices and building reports, so we understand when we go to sort of negotiate or when we go to deal with a certain landlord, we have a good understanding of what's happening in that particular market, that demographic. I mean, I've just pulled something here. It just gives us an indication of what's kind of happening in Toronto and Vancouver. I mean, rental rates are still on the way up, even after sort of a lot of vacancies, you know, back in 2020 during COVID. That certainly has recovered, depending on where you are. So, yeah, as Bill said, I mean, we'll, you know, from a high level, we'll touch on some of the key legal provisions that can have a detrimental impact on the sale of the practice. I mean, my job really is just to educate you in terms of, you know, why the lease is so important, the impact it has. You know, the average dentist will stay in the same space in some cases for over 30 years. So you just do the math on a simple $5,000 a month with annual increases, you're looking at nearly $3 million of tenancy expenses over that time period. So, you know, you have to put yourself, you know, in the shoes of a landlord. You're becoming one of the best tenants on the planet. You have the lowest default rate. You stay in the space statistically for, you know, over 23 years. You're becoming that sort of anchor tenant now. So we just want to educate the landlord from that perspective when we go to, you know, negotiate on your behalf. In terms of some of the, you know, high level financial negotiables that we negotiate, I mean, this is probably more from if you're starting a practice or in a second practice. You know, you have your base rent, annual increases, common area maintenance, fixturing, free rent. tenant improvement allowance, and landlord work. So those are the seven financial variable that we will negotiate and we can maneuver on to say. Now, I know that I know there's a few of you on the webinar that own their own building and, maybe wondering in terms of from a lease perspective, how this affects them. Um, you know, Obviously there's pros and cons of leasing versus owning a building, as you can see in terms of some of the upfront capital. I think again, what I wanted to stress that especially if you plan on keeping the real estate as a passive income for the future, you still need to have a lease in place that separates the building corporation from the practice corporation, because anybody that's coming in to buy your practice, they are going to need to finance that acquisition, and they're going to need some sort of lease for the bank's going to certainly require a lease. It normally has at least 10 to 12 years term, and essentially you're going to become the landlord as well. So you're going to need to put some sort of condition.
Lee, I'm not sure if it's just me. I've lost your audio.
Okay. Can you hear me now or not?
Yeah, you're back now.
I'm back now. Okay.
Good, it wasn't just me.
Yes. So as I was saying, so it's still very important to have a lease, even if you own the building. I just wanted to touch on a couple of provisions regarding, when it comes to transitioning. Now, there are 25 different provisions. I'm not going to go through every one of those, but it's still important to understand that it's not just the financial, the first page of your lease with the term and rent. It's the other 50 pages that can actually have a big detrimental impact on the practice, that sometimes we take for granted. So I'm just going to touch on a couple of clauses. The demolition clause, again, Bill mentioned, yes, I mean it's a red flag. There's no doubt about that. Now, it doesn't mean that you can't sell a practice with a demolition clause in it. There are, many cosmopolitan towns, cities these days that you will have a demolition clause in it. But as it says on the tin, right? If you have for example, here, if you have 180 days notice whereby the landlord can actually demolish the building, then that will have a significant impact on the valuation of the practice, right? If you have difficulty a buyer obtaining finance, the risk that the landlord can terminate the lease prior to sell, having to even relocate, you're looking at anywhere between 250 to 750,000 liability. Now, I'm just going to jump ahead of it here because it's also key for you to understand that, like I said, that there are certain things, especially where we're involved. Now, best case scenario, if we can remove a demolition clause in its entirety, then great, wonderful, and Bill would be more than happy for that to happen. Now, I'd like to set realistic expectations. In some cases, you're not going to be able to actually terminate the demolition clause completely. But there are things that we can do to, improve the language or actually improve the termination clause. Like if we know, for example, that they actually have no plans to tear down the building, and there's some other leases that maybe that they're tied in for 5 or 10 years. If we can get something written, whereby a blackout period, say a 5 or 10 year deferral, it can make a significant impact onto the valuation of your practice when it comes to sell. I mean, you can see here a practice valuation just over 1.9 million with no demolition, no termination rights. Whereas if it has one with a termination right now with maybe 180 days notice, that can wipe $600,000 off the valuation of the practice. But if we're able to maybe defer that by 5 years, or if we're able to extend the notice period, there's certain things we can do to improve that. Just by a 5 year deferral, there's another $300,000 nearly in your pocket. Um, I also just wanted to touch on the assignment clause again, because this is another key provision when it comes to selling the practice. Anyone that leases a space, you have to get prior written consent from the landlord to transfer the lease. If I'm a landlord, if I'm bringing in, if somebody else is coming into my building, I want to know who they are. Now, again, our job is to make the language is educate the landlords that certain conditions, like you see here, this is written in 75% of dental leases that I see on a regular basis, and they're just not written for a dental tenant. You have to give prior written consent. Now, in this example, landlord has three options. One, it can just accept the conditions and approve the assignment. Two, simply just decline the tenant's request. And three, can terminate the lease agreement. Just for asking permission to transfer the lease, the landlord can terminate the lease agreement and literally pull the rug right underneath you. Unfortunately, as you can see in this example, it actually gets worse, where in some cases the landlord may be able to revise the minimum rent paid during the term of the rent, the term of the lease. So in some cases they may say, okay, I'm happy to give consent, but I'm going to increase the rents by 15% for the next buyer. So if if I'm buying your practice and I'm going to first thing I'm going to do is reduce my asking price by 15%. Um, the other issue that we see, and again, which one of the reasons why I'm passionate about what I do is, some landlords want a percentage of the sale proceeds, right? You've worked in the same building for 30 years and your blood, sweat, and tears, and the landlord's saying, well, my buildings help your practice grow, and they want a piece of the pie. And our job is obviously they shouldn't be taking any proceeds, any percentage of sale. So again, very high level, but just on this one provision, again, the ability to not be able to sell your practice, absorbing significant increase in rents, remaining liable as a guarantor beyond sale, paying a portion of the percent of the proceeds of sale, anywhere between 250 750,000 liability. And as Bill said, we see it a number of times why practices fall through at the 11th hour is because of the lease. Um, this is actually a review that a Google review that I mean we don't like the situation. We're proud that we're able to help, but this Dr. Amira who tried to sell his practice three times at 74 years of age was actually forced to relocate the practice. Fortunately, we were able to cover a lot of those costs that the landlord to pay for the new build out, and negotiate good terms, but literally had to move at the stage of his career just to get the value of the sale of the practice. Um, there's a couple of case studies that I wanted to just again bring to your attention. A doctor came to Cirrus, had one of the worst lease terms, completely landlord friendly, and really exposed to a lot of the sort of traps in the long term. Once we were involved, we were able to release some of the liability after sale. We removed the sale proceeds language. We had the right of first offer, and ensured that the options were transferable as well. And that's quite key as well, because again, there's lots of times where someone might say to Bill that I've got 12 years left of my lease. And then when you actually look at it, it's got 2 years and two 5 year options. But if those options are not transferable to the buyer, then, they may not be worth the paper that they're written on. Another situation where a client wanted to raise some concern because they had the demolition clause. The clause gave the landlord the right to terminate the lease within 3 months as part of the shopping centre in Thornhill due to some redevelopment and demolition. So multiple buyers walked away just due to the demolition clause. Landlord, tenant knew that it was very difficult to sell the practice. Cirrus was involved. We were able to um, remove some of that liability. We renegotiated the demolition clause. We couldn't actually remove it in its entirety, but as I said, we were able to um, defer that landlord's right to exercise for a 10-year period, and we were to give 10-year term with two 5-year options. So all these things can just, for every time I hear a client say to me, oh, the landlord, they won't change anything, they won't do anything. There's always like, well, how are you asking? How are you going about that? What are you doing if they do say no? Um, this is a slide I like to add to most of my presentations. Just it's something we got from um, one of my colleagues who worked on the landlord side. It's essentially uh, it's a sort of lease cycle where we recommend as well. If you're looking to start the process around 2 years before expiry is always the kind of key sweet spot when it comes to a renewal. Um, Now, 2 years again gives you the time and the leverage to renegotiate, even if you don't want to move and the last thing you want to do is relocate. At least you have enough time to, for the landlord to believe that that's a possibility. That's something that you could do. They really, ideally, they want to get you down to the sort of 12, 8 months, even to the 6 months prior to the expiry date, because they know whatever they put in front of you, the likelihood is you don't have enough time to move anyway. So why is Cirrus? Why have we been so successful for 30 years? What do we do differently? How have we got over 500 five-star Google reviews and, really successful? Well, there's a process that we follow. I mean, one of them is, we gather all the information about your specific situation, where you are, what stage of your career, what you're looking to do. It's a very sort of holistic approach. Once we've identified some of your, career and your practice goals, then we will review the office lease for any risks. Simultaneously, we'll prepare some of the market research. We'll look at current rental rates in the area. We'll understand more about the landlord, the sub-market, the demographic, etc. So, once we develop that sort of strategy, we are much more prepared. Like in all these 5 stages, the one thing we haven't done at this junction, we haven't reached out to the landlord. Now, one of the things I always say, like I know that the temptation is for you to look at your leases and have a look, do I have a demolition clause, and phone up my landlord and say, can you get rid of this? And have I got this? And can I sell my practice? And are you going to take some, that don't do that. That's not a great idea. There is a method to our sort of strategy and our success, because, like I said, we look at to see, have we worked with this landlord? Have we worked with him before? Have we worked with somebody else in the same building, etc. So there's 5 or 6 things that we do, and then once we start to propose the financial negotiations, we start that. Now, from our experience, again, once we've negotiated some of the financials, because really the landlord are most concerned about what you're paying and for how long are you going to pay and what type of tenant are you? Are you going to be there and are you going to pay? So they're much more willing to make some of the legal changes to the business clauses of the lease. So we then spend 20, 25 hours on the business clauses, and then we have a final review and execution of the lease. And we're with you for as long as it takes until you have a lease, a new lease, an amending lease agreement, an assignment that you're satisfied with. So that's really concludes the my part of the presentation. I did see a question, and I'm going to read this to you, Bill, because I'm not sure if you can. Can you see the question?
I can.
No, there was a question, one other one.
I answered
Oh,
it
you answered that one.
directly,
Okay,
but
don't worry,
let
that's
me
fine.
repeat it for the benefit of the group.
Yeah, maybe it's worth repeating for everyone else because I didn't. Yeah.
Yeah. So somebody had asked, what if because I've been slowing down for a number of years, my revenue's down significantly? How, my equipment and leasehold improvements still have some value. How do you value them? And that it was a smart question because, yes, absolutely. If your practice has been in slow decline, it is quite possible that you don't have the earnings to support a value. And at that point, our only option to value the practice is to look at the value of the equipment and the leasehold improvements. But the reality is, those are also the cases where it's often better to sell the patient base than the practice. And it's absolutely why you need to plan your lease to coincide with your practice transition. That's true for all the reasons Lee talked about. And it's also true if you're not going to be selling the practice, but you're going to be selling the patients. Um, Unfortunately, an old practice with old equipment in a location that's not generating good new patient flow is not going to have high appeal to buyers. And that gets factored into what somebody's going to be prepared to pay you. So when I answered the question on the Zoom, I said, "Call me, and we can talk about your specific situation because I can give you the generalities, but those are very specific situations."
Okay, I'm going to just read. I had a question from basically said, why would a landlord negotiate with you guys to make the lease more tenant friendly when the tenant has already signed the lease? It was a great question. I mean, hopefully, from just listening to some of the points that I talked about, there's plenty. If we can get in there early, and when you go to first sign the lease, obviously that's more preferable. But if you're already an existing tenant, as I said, if you're going to then commit to another 10 years of term over a long period of time, paying, $10,000 a month plus with additional and operating costs, etc. It's just about educating the landlord. What we're asking for in terms of some of the changes, and like I said, it's not always about the financials. Yes, the rent is important, but that's where the mistakes sometimes are made because what we're talking about is the other 2025 provisions, the legal provisions in the lease that we want to amend. And when we go to the landlord and explain that, this is not, it's not costing them any money. This is just a different type of business that you're dealing with here. You're not dealing with a nail salon. You're not dealing with a restaurant that, defaults every year or changes hands. You're dealing with somebody that's going to be there for 10, 20 years. And yes, you've spent a lot of money. They know that in terms of equipment. But, if you start the process early enough, um, and you're in your stage of your career, if you really don't like the terms of the lease and the landlord may not be the best person to work with for the next 10, 20 years. So there is, as I've said, there's a number of reasons why they will make some of those changes to the lease. I think there was one other question. Hold on. This
I've
is
seen one here. If my EBITDA gradually increases over 2 years before I sell, which EBITDA number is used? Do you use the average over the last 12 months? Yeah, generally, I said earlier, you're generally only as good as your last 12 months. So, if your EBITDA was 500,000 a year ago and it's now up to 600,000, so long as one can see growth in the patient base that corresponds with that, the 600,000, not an average, would be the number most appraisers would use.
okay. Excellent. Um, if anyone has any other questions, there is a question there. What is the difference between the practice versus the PTS? I don't know. That was a practice versus the.
Oh, this is one I don't see on my end.
It's on a webinar. It's on the chat. hold on.
Oh,
Oh,
check. Okay.
practice versus patients. I think this is one for you.
Yeah.
What is the difference between the practice versus the patients?
Patients. No, difference. Yeah. The I think what you're asking, and if not, just type it back into the chat.
I'm
Is I
talking about reappraisal, basically, when you said earlier, like with your practice versus.
yeah, sometimes you're going to be best off selling your practice, sometimes selling your patients. And it's really, if you look at your practice through the eyes of a buyer, are they going to want to buy the practice? So let me give you an extreme example. You've got a practice that you unwisely had never hired Cirrus to work with your landlord. You've just signed a 10-year lease with a demo clause, and it's in a plaza that the landlord hopes to redevelop, and therefore he's not going to yield to whatever anybody says. You're locked in for 10 years. Your only choice is to try to sell the practice because you can't sell the patients to another office. But if you're in that same situation and your lease was expiring this year, then the patients may be more valuable. As a rough rule of thumb, it varies a lot based upon the nature of the patient base, how old they are, how much hygiene they're getting annually, how much dentistry they're paying for annually. But patients will sell for anything between $400 to $800 a patient. So if you've got 1,000 patients, that's $400,000 to $800,000. But if you used to have 2,000 patients, you're down to 1,000, and your rent cost has gone from 8% of your revenue up to 16% of your revenue. Those patients may be more valuable in the practice because you're spending so much on rent. So as I said, it's very case specific. But my rough rule of thumb is, do you have 1,000 patients coming at least annually or not? If not, are you generating sufficient new patient flow to build it up? If not, talk to an appraiser about whether your practice, your patients are more valuable. Oh, I see the next question. Isn't that goodwill? You started saying this is not relevant anymore. No, the distinction here is if I'm selling a patient base, what I do is look at the earnings coming out of the patient base to the person who's going to buy them. It's still earnings based. And that's why it's very relevant how much hygiene those patients are getting and how much dentistry. And what we do when we're selling a patient base or valuing it for that matter, we look at the revenue that patient base will generate and then the costs that would be associated with that. So variable costs. If I buy your patient base, my supply costs are going to go up in line with the dental treatment I'm doing on them. I'm going to need more hygiene hours to do hygiene. I'm going to need more chairside assistant hours to do dentistry. I may not need reception hours. My rent's not going up. My general repair and maintenance isn't going up. So we look at the economic gain to the purchaser of the practice and drive the value off of that. It's not exactly, well, it's still pretty much an earnings multiple based approach.
Okay, Bill, thank you. Just if there's anyone else got any questions, I'm going to just launch a last poll, just a kind of exit poll. If you don't mind, some of you may have missed some of the beginning. If you could just take a minute to fill that in, I would appreciate that. In terms of, I know a few people have asked about CE credits. You have to stay on for the duration of our presentation, which will be finishing shortly. We don't want to take up too much of your evening, but that will. I believe you will receive that via an email within the next sort of 5 to 10 business days, because I know a few people were asking about CE credits. So if can everyone see the poll that I just launched?
I
Seems
can,
like
but I may not be representative.
no, as long as you can see it, but I just wanted to see. It doesn't look like anybody's actually filling
I
that
can't
in.
see it.
from panelists to all panelists, no. Okay, let me just try that again then. Doesn't look like that. Let me launch that. Exit poll. I don't know. Doesn't look like that. I don't know if I can relaunch poll. Hold on, let's go. Okay, now you should all be able to see that. Yeah, so if you could all just take just a minute before you, I appreciate before everybody leaves, just to fill that in, and we'll give it a minute or two. If there's anybody else got any more questions for Bill and myself, please feel free to raise your hand. There's the chat facility, the question and answer facility. We do appreciate everybody taking the time out of their evening.
And I'm sure this goes for you, Lee, as well as for me. If any of you want to talk over situations unique to your practice,
Yeah.
just reach out. You can find our names and contact details on our respective websites. Mine was up on my first slide, but don't hesitate to reach out because it's what you don't know that's going to hurt you. And my greatest regret doing what I do is when somebody comes to me and they didn't do the right things with their lease at the right time, or they didn't structure their corporation to get capital gains exemptions, or they could have done so much to build value and just didn't realize it. So this is your most important asset for most of you. Many of you will be depending upon selling it for your retirement. Don't hesitate to reach out.
Yeah, I would certainly agree with those sentiments because every case, every practice, every is unique to your own situation. So we're all obviously more than happy to spend some time on any of your existing situations. It looks like there's no more questions, so I thank you again. Thank you, Bill. Always a pleasure to present with you, and appreciate everyone's time. And everybody enjoy the rest of what's left of their evening. Oh, there's one more question that's sneaked in.
I love this question. Somebody said, if accountants are supposed to reduce your taxes, why won't they give us any advice? My simple answer would be if your accountant isn't giving you good advice, it is time to get a new accountant.
Yeah, we can certainly recommend a few accountants for sure that would.
Yeah,
give you some advice.
This is broad, especially if there are buyers out there still listening. I'm sure we're losing people now, but
We've still got
need to deal
27.
with people who know what the hell they're doing. That means an accountant who only does dentistry or only does medical work. They'll give you good advice. And this person's been through a bunch of accountants. Email me, call me, let me know where you're located. I can get you the names of some people who will be prepared to give you advice. They'll charge you for it, but it's money well spent.
Excellent. We've got a lot of love for that last comment. Okay, I think we're gonna say cut it there. Again, thanks everybody for their time. Enjoy the rest of your evening,
Lee,
and
thank you.
we'll
Have a
see you
great
all soon.
evening.
Thank you. Good night.